Welcome to the Financial Foundations Podcast, your gateway to the fascinating realm of finance, brought to you by Base Wealth Management. In this show, we delve deep into the world of money, guided by seasoned experts who will unravel the complexities of finance and provide you with invaluable insights and practical advice. Now, here are your hosts, Dustin Taylor and Alex Wolf.
Welcome back to Financial Foundations, brought to you by Base Wealth Management, where we are the foundation to your financial plan. I'm your host, Dustin Taylor.
I'm your co-host, Alex Wolf, certified financial planner.
And I'm Kyle Howell, the financial advisor in the Lutz, Florida office.
Today we have with us Caitlin Kasiba, who is a senior accountant at Murtha and Fleischl. Caitlin, thanks for joining us today.
Thank you for having me.
So Caitlin, to kick things off, what is something that someone with a side hustle needs to decide what type of business they should have?
Yeah, so when they have a small business or something that they're doing on the side, first thing they want to figure out when determining a business structure is who all is involved. If it's just them, if they have partners, because that's going to go into the initial setup. Next steps with determining the current size of the operation and if they intend to grow or keep it something even smaller.
So what are the basic differences between a sole proprietor, an S Corp, et cetera? What are some of the differences there?
Yeah, those differences are going to be, the amount of owners, what kind of tax return that they're going to be filing at the end of the year, and if they're going to end up paying self-employment tax depending on the structure that they decide. A sole proprietor is going to be, they're a contractor, they're getting paid directly, to them, their social security number. And all of that business activity is going to be reported on their personal tax return. If there are going to be more than one owner, that's where you're going to learn to even go into a partnership. That does require separate business tax returns so that each partner can report the business income on their personal return as well.
What about for a multi-member LLC? That's just a pass-through, right? So you would pay the taxes on your personal return.
Yeah, that would be a 1065 partnership return. And that, again, is a pass-through entity where the business tax return really is going to be informational. The income expenses are going to be reported, but then each owner receives a K-1 so that they can report that income on their personal tax return.
In researching this myself, most situations I saw that made more sense to do the multi-member LLC rather than a partnership. What would be an example of when a partnership would be more beneficial?
Well, if there's more than one owner, it is automatically going to be a partnership. Where you're going to run into kind of a different business structure where there are more tax benefits is moving and electing to be an S corporation, which an S corporation can have one owner, but it can also have it can be a multi-member organization. And that's where self-employment tax savings is going to come into play.
So what is the process like for someone who wants to become an S Corp or make the S Corp election?
Yes. The S Corp election is a form that gets filed with the IRS. It's Form 2553. And what that's doing is you report your business information, all owners, their ownership percentage, and you're requesting that the IRS start to tax you as an S Corp rather than on your personal tax return. You do have 2 months and 15 days once the beginning of the year starts for the election to be effective in that year to file that 2553 with the IRS. If it is filed past that date, which is going to be March 15th, there is the possibility of a late election. There's just no guarantee that the IRS will accept your request. Otherwise, they will just make it effective for the following year.
What are some things that people get wrong about an S Corp?
I think a misconception with S Corps is it's a way to completely avoid self-employment tax, and that is not the case. There are requirements that the IRS has for an S corporation, one of them being that all active owners do have to be on W-2. And that's where Social Security, Medicare taxes are being paid, rather than when you file on your personal return, your business income is subject to self-employment tax, which is the Social Security and Medicare taxes. Being an S Corp saves you on self-employment tax because the business gets to deduct half of those, whereas as a Schedule C on your personal return, you're covering the full 15.3%.
Is there a certain revenue level that it makes sense to become an S Corp, or because I would say there's a certain amount like below the annual income, it doesn't really help?
Yeah, absolutely. We typically will advise clients around 60 to 70,000 of net profit, where that's going to start to become beneficial for them. And the IRS requires that owners pay themselves a fair and reasonable salary. So when you're profiting 60 to 70,000, that allows for you to satisfy that requirement and still benefit from the reduction in self-employment tax. There are additional fees that come with an S corporation. The filing fee is higher than the personal return with the Schedule C. And then you're going to need to be on payroll. So there's payroll processing fees involved as well. So you just want to make sure that you're profiting enough that you're going to save that amount in self-employment tax.
So Caitlin, you and I have been partnering together for a couple of years now, and I recently switched my accounting over to you, and you helped me get set up on a W-2 for the first time. As people are starting their own businesses, and like you just mentioned, a minute ago about, having profits, at what point does somebody need to absolutely get onto a W-2?
The threshold that they want to be looking at is where they have enough profit to pay themselves a fair and reasonable salary, where they're not they're W-2ing themselves their entire profit. Typically when we say fair and reasonable salary, the IRS does not have an exact amount. That is open to interpretation. So we will tell clients to say, if you're going to hire somebody to do what you're doing, where would they be salary wise? That's a good place to start. And the salary can always be adjusted based off of profit. But if you are making enough to be taking the distributions and you still have leftover profit, that's when you want to start yourself on W-2.
That's a great segue into my next question, which would be, what does that look like taking W-2 salary versus distribution from an S corporation?
W-2 salary is going to be fully deductible to the business. So whatever wage that you decide to pay yourself for the year is a deductible business expense. So it will reduce your profit. But you will be reporting that income on your personal tax return as well. The difference between that and a distribution is a distribution of profit. It is something that you're going to pay tax on that profit at the end of the year. And that's now your money to distribute and use as you wish because the tax has already been paid on it. Typically, that can happen via, you can do a bank transfer, you can write yourself a check. That is not a deductible expense, so that will not show up on your profit and loss, but it is money that you've already paid tax on and you can distribute and use as you wish.
So when you say that taking a distribution has, the tax consequence, and you're saying you have to pay the tax, who is paying the tax? Is it the business owner or is it the business themselves?
It is the business owner. An S corporation does not, when you file an S Corp return at the end of the year, there is not going to be any tax due with that tax return. Each owner receives a K-1 form with if it's one owner, all of the net income will be reported on their K-1. If there's multiple owners, it will be split by each ownership percentage. And that K-1 form will have the net profit on there so that you can use that to report the income on your personal tax return. That business income will be included with any other income that you may have, whether that be W-2s from other sources, investment income, interest, and that will become your adjusted gross income on your personal tax return.
I think this is really interesting. I've been a W-2 employee basically my whole working career. But when you find someone that makes the switch from distributions to W-2, are they paying themselves monthly, quarterly, lump sum?
I have seen all of the above. The IRS requires a W-2 from your business at the end of the year. They don't care how frequently you pay yourself. So we have some business owners that will pay themselves the same frequency as their employees. We will do some that, it's one lump sum in December when they know what their business profit is at the end of the year to know how much they should W-2 themselves. And with that, it really is personal preference of the business owner on how they want to budget their personal finances and what works best for them.
So in that instance, are you helping them pay estimated quarterly taxes along the way?
Yeah, so that is a service that we're going to provide with our tax return filing or our tax planning is determining what those estimated quarterly payments should be, what they should be setting aside for it, and then also being there to make adjustments to that throughout the year if they see an increase in income, a dip in income, just so that they're staying on track for the end of the year.
Going back to the business owner paying the taxes, so how important is it, I think I know the answer, for the tax payment to come from the personal account of the business owner and not the business account of the
It's very important because the business owner, it is being paid through their personal tax return. It is best that they're paying that from their personal account. Not to say they can take a distribution from the business of their portion of the profit that they're eligible to pay that tax bill. But if they were to make a payment from, let's say, their business account to cover that, it is going to be considered a distribution.
And whenever we switch to multi-member LLC, is the only difference then is that that the other members also have to be paid a fair and reasonable salaries through the S Corp?
Yeah, so any owner listed on the business that is active in the business, they're participating, they are required to be on U2. Any owners, if they're more of a silent partner where they're just had invested in the initial business but are not active in it, they are not required to be too.
So what are some common tax mistakes that you see people make or business owners make?
I think the biggest mistake that I see with small business owners is them thinking that their profit throughout the year is entirely theirs and not setting money aside for taxes at the end of the year. Especially when there are business owners that started as a W-2 employee and then switch to owning their own business, is W-2s are withholding taxes for you throughout the year. You don't even have to really think about it. As a business owner, they're not. And every deposit that hits the bank account from your business, from the income, is not all yours. So setting money aside is incredibly important so that at the end of the year, when you have that tax bill, you're prepared and that money hasn't already been spent.
Yeah, we definitely don't want those 5 and 6 figure tax bills. I've had those before.
Yeah, and well, hopefully you have a very minimal tax bill at the end, or even like, for instance, I have money back because I pay my estimated taxes and I pay more. So ideally that's what you would do. But how bad are the penalties if you don't pay that? I think that from what I understand, the penalty's not that bad, but then there are some other caveats to how the cost could be increased if you don't pay your estimated tax.
Yeah, quarterly estimated payments are there to avoid an estimated tax penalty at the end of the year. They're not required. You can choose to not make the payment, but you are setting yourself up for that estimated tax penalty. So it is best to make those payments. One, that way you're not paying any unnecessary penalties at the end of the year, but it also avoids there being a potential large lump sum that you're unprepared for. And so that allows you to separate out those payments, and it's a less of a blow at the end of the year when you're making all of it at once. And it also helps you better budget throughout the year. If you're making those payments and have that money set aside, then you're not going to put yourself in a situation at the end of the year for those funds to not be available.
How often do you deal with business owners who may take that money that they would pay in estimated taxes and invest it instead, and then pay it at the end of the year and have made money on it? Because that's what the government's doing, but they want their money up front so that they can make the interest payments on it.
I do have clients that will do that. Rather than making those payments, they set it aside in a savings account and let it earn interest throughout the year, because it's often that they believe they can earn more interest on it than they're going to pay in an estimated tax penalty anyway. So I do see it on both ends. I have clients that will make those estimated payments, and then I have some that would prefer to invest it.
Are there any deductions or tax breaks that people often miss, I guess, other than electing the S Corp?
Yeah, there are some deductions out there for small business owners that not everyone is aware of. There's a home office deduction. So if you're working out of your home, you have a dedicated workspace, and you're not paying rent to an actual location, an office space, then you do get to take a deduction for that space in your home. It allows you to take a percentage of your electric, your rent, or your mortgage interest, your property taxes, to account for the space that you're utilizing in your business.
Yeah, one thing I've seen that I didn't think of is like a cleaning fee. If you're paying like a cleaning fee for the whole house, I think that's also deductible, right?
Yeah, so it's going to be utilities, insurance, property taxes. Those maintenance costs that you have throughout the year. And even that percentage is based off of the square footage of your office space compared to the square footage of your entire home, so that you can take even a portion of those costs that you have and are utilizing in your home office.
When it comes to like retirement planning and financial planning, which is kind of my area that I specialize in, are there certain considerations with business structures that can help put someone ahead financially versus a different means?
I think having the business structure determined for tax planning is extremely important because of because of things like self-employment tax. When you're dealing with a sole proprietorship or a single member LLC that's being reported on your personal tax return, you're subject to self-employment tax, which you definitely want to plan for. Whereas if you have a structure of an S corporation, that is something that is going to be reduced, but you also have to anticipate W-2 income, which can come with withholdings. So having the business structure set allows for better tax planning.
Have you seen where people who are self-employed or have a small business don't actually pay themselves enough to maximize their Social Security benefit?
Often, yes, because when people have a small business, they want to keep as much money in their pocket and not, they want to reduce their taxable income as much as possible. So they believe that solution is not paying themselves on W-2, or if they are, a very minimal amount, which isn't always, in the moment it looks beneficial, but it isn't always. That can come into play with even 401k contributions. With that, is if you're paying yourself a low W-2 wages, you could be limiting yourself in that aspect as well.
And I've also seen with you saying that for businesses that aren't necessarily sellable for retirement, somebody that's getting ready to go into retirement and they've never paid themselves a living wage, they have nothing to fall back on because they don't have Social Security. Maybe it was a cash type business. They weren't saving for retirement because there was a cash business. They spent all the cash. They weren't paying into Social Security, and now they have a business that they can't sell. So that's another good reason to make sure you're paying yourself a W-2 salary.
Right. Yeah, that kind of tees up the next question is what's the best way small business owners or self-employed individuals can save for retirement? Like what types of plans do you think maximize their potential contributions and savings into?
Yeah, so the different kinds of retirement accounts that they can look into for contributions are your typical traditional Roth IRAs. But if they're looking for something with higher contribution limits, there are even solo 401ks, SEP IRAs, simple IRAs that they can look into contributing to.
I think that it would be interesting from a financial planning perspective to consider the money that you're not paying in the taxes, even though it would reduce your Social Security in the long run. But if you took that money that you were saving each year and invested it, would it make more?
It could. Yeah. I mean, obviously, what you've paid into Social Security for a lot of high income earners is going to be more than what you could potentially get out of it. So, yeah, it could be the case. And we could put that into our financial planning software to kind of model the difference.
So Alex and I have worked with, many of small business owners and figuring out, what's the best type of retirement plan, for an individual owner, whether it be a solo 401k or a SEP IRA. Caitlin, do you have a preference whether it's SEP IRA or solo 401k or even a simple IRA? Does it really matter in your frame?
What they choose to go with isn't going to make a huge difference as far as the filing process. I think them picking an account is determined based on their structure and what's going to work best for them on a personal standpoint and their business. Things that can come into play with that is how many employees they have and different aspects like that. So choosing a plan is going to be determined on how many owners there are, what kind of contributions they're looking to make.
Yeah, I've run into this with later in life for business owners that are, in their 40s and 50s, and they come to us. And I wish they would have come years ago because they spent most of their money that they were making in the business trying to grow it as much as possible. And they never really thought about the future of themselves. And some people get away with that because they have a business they could sell and it's worth something. But there are instances, as Kyle mentioned earlier, where the business isn't really sellable. There's nothing to sell. In that case, they come to us and say, well, how can I get ahead now, or what should I do now? And coming up with the right type of retirement plan where they can fund it more heavily than they could others. What's your experience with that?
Yeah, I think sometimes with business owners is when they're especially in the startups, is that's not really something that's on their mind. And then it can come into their mind a little too late, where they're more focused on the growth rather than their future as far as their own personal retirement savings, because they're not working with a W-2, a 401k that's happening kind of more in the background.
When it comes to working with other financial professionals, what benefits do you see, or how do you help clients kind of use financial planners or advisors incorporating tax planning and even maybe estate planning or legal lawyers, or however to structure or file things for their business? What do you think the benefits are to a self-employed individual with working with a group of professionals?
Yeah, when you work with professionals that are able to then work with each other, it makes sure that everyone's on the same page as far as taxes, like you said, their estate, their financial plan, so that no one's contradicting each other. You want to make sure that the plans that you're making with your financial advisor are also good for you from a tax standpoint. And when you have a tax professional and a financial advisor, an attorney that are all working together, they can collaborate and make sure that everyone's on the same page. and making decisions that are going to be best for the client.
I don't know if this is a real question or if you have anything to say about it, but I've run into this a couple times with clients, retirees. So they're not small business owners or anything like that by any means, but they took a big distribution out of a retirement account for a big purchase, a trip or something, and either they didn't withhold taxes or withhold enough, and now all of a sudden they go to work with their CPA and they're like, well, you didn't withhold anything or enough, and now is there a penalty, or they may need to do quarterly estimated taxes?
See that all the time.
Okay.
Typically with withdrawals, especially, it depends on if it's an early withdrawal or not. But I feel like a standard withholding percentage to start with is a 10% withholding. And I think clients and taxpayers will assume that whatever they decided to withhold on it was enough. That's typically not the case, especially when it's a larger distribution, because not only is it probably not withholding enough for the income that it's going to increase for that year, but it's also not accounting for the other income they have on top of that distribution. And that can cause estimated tax penalties because their income increased from a prior year.
And this is really where working with your financial advisor makes a whole lot of sense. Same situation I had 2 years ago or 3 years ago now. An older couple looking to buy a piece of property. It was 25 acres. It was like 1.2 million. IRA of 3 million. And we took 500. We had some planning going on in the background, but they took $500,000 because normal required distributions about $180,000. So it bumped them into another tax bracket that they're not accustomed to. But because we did the tax planning ahead of time, we were able to show, let's take 35% and send it to the IRS. So they didn't have that big tax bill. They actually got a small refund back. So work with your financial advisor when you're taking large distributions. If you don't have one, let us know.
Some business owners run their investment properties as businesses. So how does it work if you are planning to take a loss on an investment property? What are the rules for that?
Losses on passive income with investment properties can be limited. That is something that I think taxpayers are sometimes unaware of, is they think that if they have a rental and they have a huge loss on it because they just purchased this, they remodeled it, may not be the case. The IRS determines allowable loss based on your income. And what I will find is even with high income earners, that loss is not deductible. It becomes a carryover loss. So you do not lose it completely, but it does get carried over to future years to either be utilized on a year that the investment property has a profit, or to continue to be carried over and accumulate until the property is sold. But just because the rental property has a loss does not necessarily mean that it is going to be a deductible loss on your tax return.
And the interesting thing to me is that the thresholds are quite low and they're not even adjustable if you're married or not, right? It's the same.
Correct. And that those limits are based on your total other income. So it's going to be W-2 income, investment income, because it is calculated based off of your adjusted gross income. And with that is, with the accumulation of your income, if it is past that threshold, is you're automatically not allowed to take any of that loss.
To me, it's like it's 100 or 150, and then it tapers off at 150, right?
Correct. And they do also limit that loss up to, even if your income is below that income limitation, is they limit you to a $25,000 loss, and anything above that will get carried over as well.
I'm just curious, how often do you even see that? Because I feel like if you have enough money to have an investment property and you're getting rent from it, and then you have another job, you're going to easily hit the 100,000.
A lot of my personal clients that have rental properties, in most cases, if they are operating at a loss, it is not going to be a deductible expense to them because the threshold is so low.
So switching gears a little bit, I know we've been focused on small business owners, but what about high earning W-2 employees? Do you have any suggestions for them for tax deductions at all?
The first thing that we look at with high income earners that are on W-2 is to make sure that they're maxing out their 401ks, because that's the easiest way to reduce your taxable income with W-2 earners. And then the other things that we're going to look into is HSA accounts. If you have them, are you maxing out those contributions? And then you're looking into investment properties, small business, but those do have to be legitimate businesses if that's the route that you're going to take.
Right. So one of the things that I could add on to that would be, looking into your 401k plan. If you're maxing out your contributions, does the plan allow for after-tax contributions? So you have your limit, whether it's $23,500 if you're under 50 or it's $31,000 if you're over 50. The plan allows you to go to $70,000 with your match. So if there's additional funds that are available and you can throw those into your 401k on an after-tax basis, we can look at creating a very, very large Roth IRA in the future by using those after-tax dollars in the 401k plan if it allows it.
All right, Caitlin, thank you for joining us. That was very insightful.
Thank you for having me.
If you'd like more information and financial advice, you can visit our website at basewealthmanagement.com. You can watch our videos on YouTube, read our articles, or subscribe to this podcast.
If you have any questions that you'd like to see it or topics that you'd like to see us go over or talk about on the podcast, you can send those in to us at question@basewealthmanagement.com.
Caitlin, how can they reach out to you if they'd like to?
Yeah, they can go to our office website that will have our office phone number and emails all listed on there.
All right, thanks. I'm Dustin Taylor.
I'm Alex Wolf.
And I'm Kyle Howell.
Happy listening.
We hope the expertise shared by our hosts, Dustin Taylor and Alex Wolf, has left you feeling empowered and informed. If you're eager for more financial wisdom, don't forget to subscribe, rate, and share the show with your friends, family, and colleagues. Until next time, stay sharp in the world of finance.